This conference will now be recorded.
Well, good morning, and wherever you are, good afternoon too. This is JoAnn Forrester, the Empress of Biz, with Sal, the Duke of Business, and we're continuing our series on buying and selling a business. We thought while we were in this quarantine period, it would be a time to make things productive. Most of us or many of us are sitting home, and you've cleaned the closet, you've scrubbed the floors, you've done whatever you need to do, uh, and now you are okay. What am I going to do with myself? Well, maybe you're thinking of starting a business, maybe you're thinking of buying a business, maybe you're thinking of selling a business, and we are going to talk about the process. Now, Sal generally represents the seller, the person who wants to sell his business or her business. And I generally represent the buyer, someone who wants to start, who wants to move out of the corporate world or expand their horizons and buy a business. Processes often vary the same. You have to take a look at yourself financially. You have to take a look at what you're willing to risk, what you're willing to give up, what you're willing to do to get the transaction done. This is often the biggest deal of your life. Usually people, when they buy a house, that's the most money they spend, but this may be a lot more. So to be prepared to see if you're ready for it, this is why we're doing this series. Welcome, Sal, and good to see you.
Well, thank you very much. And it's very exciting to continue your series and continue talking to the general public at this quite historical juncture in time with the coronavirus. And hopefully we come out okay on the other side. And thank you for the introduction.
You're welcome, and we are going to come out okay. It'll be interesting. I would love to be investing in some new technology. I have some ideas. I'll have to talk to you afterwards. But the first thing I do, Sal, and I know you do a version of that, is where's my client financially? What does he or she bring to the table? What are their assets? What are their liabilities? What is their attitude? What is their family's attitude? What is their support system like? So I'm looking at this, are they ready to take the jump? And you're looking at, well, are they ready to take the jump and leave the business? And what do they want from it? So one of the things you and I talked about is a personal financial statement, a snapshot of where the buyer is, and also the seller, because it's kind of like, is it you want to get out of Dodge real quick? You want to get rid of the business? Or I got time, the sheriff isn't going to arrest me. I've got time to make this deal, and I've got time to make it that it's beneficial to both. Maybe I'm willing to hold paper, to hold part of the deal. So, and I buy as the seller, I need someone to hold part of that. What do I bring to the table that is going to make the buyer more comfortable with me, vice versa. So would you bring up the personal financial statement and tell us where you got that?
Sure, absolutely. Let me bring that up. And so I'm actually going to show two. This one, as you can see, first of all, to answer your question, is SBA Form 413. And right here at the top, it says personal financial statement. And basically, that's exactly what it is. And just to maybe walk through it real quick, here is, just your name, your address, things like that. This column right here is your assets, which roughly speaking in layman's terms, without getting too fancy, is pretty much a list of everything you own. On this column here, you have liabilities, which again, roughly speaking, in layman's terms, is everything you owe. And here we have this one line that's the net worth, which is basically a plug figure that makes this column and this column add up and be the same, because that's very important. This column and this column, your liabilities and your net worth, has to be exactly the same number as this. Ideally, if you have more assets than liabilities, then your net worth is a positive number, and that's a good thing. And the bigger that positive number is, then the better and the more solid financially you are. And not to walk through the whole form, but this is basically a snapshot in at an instant in time of all the financial transactions that have accumulated up to that point. Here we have your sources of income, okay, which is for a period of time. So, again, salary, investment income, real estate income, and so on and so forth. And then beyond that, there's some space to maybe detail some of the previous. So this is an actual SBA form. And to take a step back, by the way, this is obviously something that is done by the buyer. But a lot of times, sellers are also interested in looking at this information, or perhaps another one that I'm going to show in a second that's a little bit simpler. The reason being, as a seller, you want to qualify the buyer. It makes no sense to engage in negotiations, engage in disclosing information, and engage in all the song and dance that's necessary to sell a business, to have the buyer absolutely positively fall in love with the business, but then they're simply incapable of doing the transaction because they just don't have the financial wherewithal. So again, as a seller, you want to do a little bit of homework, due diligence, whatever you want to call it, at the beginning, to make sure that you're talking to buyers that, if they decide they want to do the deal, are financially capable of pulling the trigger. Here is, to that point, buyer qualification snapshot, which again is very, very similar. This is a little bit simpler, so it doesn't, scare people as much, because people get scared and confused with filling out forms and paperwork. We talked a little bit about this last time. But again, same thing, their name, their address, things like that. Here again, just a list of all the assets, a list of all their liabilities. And then it says here, subtract total assets from total liabilities, and here's your net worth. And then a signature and date. And this is literally a one-page form that doesn't require really bank accounts or disclosing, things like that. It's just, again, just to make sure that based on this information, if the buyer decides to buy the business later on and pull the trigger, he's got the financial capability to do that, because the second page is just reasons to buy an existing business, and it's just a little one pager for the potential buyer to read. So I hope that makes sense.
Right. Is that an SBA form there too?
The second one is not. The first one is.
Okay. Could you go back to the first form? Because I want to point out a couple things that
Sure.
I have found that when my people do that, or when we review what they've done, when on the left-hand side, on the asset side, under other assets, I find that many people underestimate. They do one of two things. They either underestimate or overestimate the value of their assets. And when you take a good look at your situation, it's always surprising how much money you've actually spent on furnishing, on jewelry, on your collections, on your tools and that. One deal that I had where a client was wanting to start his own garage, and had found the right location and wanted to build a building. We were short of collateral, and the banker loved him. She took her car to him all the time. He had been a client. He had taken my classes. His credit score was good, but his net worth was not sufficient to do the deal at the size we needed to do. And they have ratios about what they're looking for. And then what we found, and I did some digging, and he had, and this was not an exaggeration, he had at least $100,000 in tools that he had been buying to prepare for this venture. I actually went, and he had a warehouse rented. And the banker and I went, and when we counted the assets, we were just standing there looking at each other, and she says, "We've got at least $100,000," she said, "at reduced value in tools." And what she meant by reduced value is very rarely will they give you 100% of the value of what your equipment or tools and that were. So we were way within the range, but because he didn't think of that, and I started to dig, because I knew him. He just, I knew that he bought any tool that walked around, but that made the deal. And when you look at the value of, some of you may be collecting coins, some of you may be collecting art, some of you may be collecting whatever. There's often value. We found a baseball collection, and I'm sitting there, and I love baseball. I know sports. Well, we had a Babe Ruth card, an actual Babe Ruth card. That thing's worth money. We sold it to make the deal, So I always tell people, don't underestimate what you have. And not only that, when you make a complete inventory, you need to give that to your insurance agent. If you have a financial advisor, give that to that person, because that gives them an idea, one, what you have, and two, the replacement of what if something happened. And that's important. My insurance agent, just looks at me and goes, what are you bringing me? I bring them snapshots. I go, I want this back if something happens. I want the value back. But I learned that from a tip from an insurance agent who said, if you really want your full value, you need to document what you have and take pictures. And then you have a much better chance if you have a disaster. And the way the weather is in certain parts of the country, boy, it really pays you to have it. But we've had floods here in Pittsburgh that have worked out whole towns on little towns. So that's really important, and I wanted to bring that up. And my question to you: where does the value of the business go? Is it of the business that you want to purchase? If you have a business that you want to sell, I mean.
What do you mean by in these forms, where does the value of the business go?
Yeah.
These forms, the value of the business is not shown because this is just to establish the net worth of the potential buyer. What we could do, and we started to talk a little bit about this, is figure out what the business could be worth. And then that would be a completely separate report, and there's a couple of ways to do that. One way is to engage a third-party professional to do a valuation. There's CPAs firms out there that have people that are certified, value analyst or whatever, and they'll take the information of the business and produce a report that's basically a valuation or or range of possible valuations in different situations. So that's one way to do it. The other way to do it is, without getting into too much detail, but Pepperdine University puts out a periodic report where they poll the business brokers like me, and they put out ratios of transaction values based on the seller's discretionary earnings. And that's a good report because, again, it comes from the historical transactions that brokers have done in real life in the field. So, I have that report available, and I can share it with anybody that's interested. So that's another way to do it. Another way to do it is to use just kind of a rule of thumb. And every business is unique, but the rule of thumb that I use is to take the seller's discretionary earnings, which is basically the cash flow of the business, adjusted up or down, for any expenses that the new owner may not have when they take over. And we can talk a little bit about that in detail after this. But so you take the seller's discretionary earnings, think about it as cash flow under the new owner, running it the way he's planning to run it and most efficiently. And then apply a multiple to it, which, typically on the low end could be somewhere between 2.5, 2.7 of that seller's discretionary earnings, all the way to 3.5. There's a lot of things that influence whether you're towards the lower end of the multiple, the higher end of the multiple. Obviously, that is for sort of Main Street type businesses, a retail store on a main street, on a strip mall, something like that. The bigger your business gets, the more employees, the more infrastructure, the more inventory equipment, the bigger the transaction is, and those multiples tend to rise as a transaction gets bigger, because there's less risk, because there's more diversification to the business in terms of suppliers, clients, geography, operations, everything. And the last method, quite honestly, to value a business, which is one that I happen to like, is you list it and you see what types of offers you get. Mr. Market will speak to you. And then you can decide to accept that or not accept that, or negotiate. But if you list it, you'll end up with a pretty good feeling of what this business is worth.
One of the things that you said that always sticks in my mind is a lot of people are, one of the reasons they're buying a business is they've had their fill of where they're at. They've done the corporate thing, but they know they're not ready to quit, retire, go off to Tahiti or somewhere like that. And they are basically buying themselves a job, buying themselves a future that they can have for 20, 25 years, something like that. And when they're doing that, I have found that when I look at the business and I'm looking at it, again, I'm generally representing the buyer. Often I find that there's a lot more discretionary money in there than is being representative because of the loaded expenses that the seller has in the business. Have you found that?
Oh, absolutely. That's why I always use this phrase of seller's discretionary earnings as opposed to cash flow or net profit or EBITDA or any of those other terms, because you're absolutely right. Right, wrong, or indifferent, without passing any judgment on anything, the reality in the field is that most small business owners try to take every possible expense they can find and run it through the business, because obviously that reduces their profit on paper, and that reduces their taxes, and then none of them like to pay taxes. But as a broker representing the seller and even a smart buyer, the first thing they need to do is to make all those financial adjustments. You can call it whatever you want. Some people call it recasting, but bottom line is you have to take all those expenses that the new owner will not have in the future running the business as optimally as possible and add them to cash flow. Okay. And some are just completely unnecessary. Some are borderline unnecessary. And just to throw out a couple of examples, and I'm sure you've seen the same or even more. Sometimes they'll have a spouse on the payroll that does either literally nothing or very little. They might have spouse, kids, family members with medical plans, with cell phones, with company cars, whatever the case may be. And those are the first expenses the new owner is going to get rid of the minute he starts. Just to paint a real life case from a couple of years ago. I had a client in West Virginia that I was representing to sell his business, and he had one client out in California. Because he had this one client out in California, then his kid who was living out in California, they would pay for his cell phone, his medical plan, his car, which was a BMW, by the way. So there was all these expenses associated with taking care of one client in California. I'm sure the new owner will reevaluate that, and he'll make a decision of, okay, listen, I want to keep the client, but maybe I'll have a distributor or a rep or somebody part-time just kind of take care of that client. Or, you know what, it doesn't even make sense to have this one client sitting down in California. This thing could break several ways, but what is clear is once the new owner takes over, that BMW, that cell phone, that medical plan is going away one way or the other. Right. So we add that back to cash flow and to come up with our seller's discretionary earnings. And that's important for the seller to know and the buyer to know.
Mm-hmm. One of my clients, for whatever reason, he had everybody in the world on his cell phone plan. And the cell phone was up over $1,000 a month. Now, there's no way that my potential buyer was going to have that. He not only had his wife and his kids on, he had his aunt, he had his uncle, and they weren't, they were just all part of it. And then he had his girlfriend, which created another problem on top of it. I was there that day when everything hit the fan, so it was not fun. But that was you see that type of thing that happens, and often they don't want to pay taxes, but like I tell them, you want to sell this business someday, so you need to treat it like a business and actually show profit. And if you have to pay taxes, that's okay, but are you also starting your own pension, your own IRA, your own KALE plan? There's ways to do that actually builds your net worth, that doesn't take in adding all these additional expenses. I've often, found that's the course that we take, something that builds the net worth, while, it's nice to have a pension plan, not only for yourself, but for your employees. That makes a difference.
Yeah. Well, not only that, a couple of things to keep in mind. One is a lot of these loans are going to get approved by the banks by whatever's in the tax returns. So, if your tax returns show a very low profitability, it's just going to make it that much harder for the buyer to go to the bank and get a loan approved. So that's one issue. In addition to that, a couple more issues. The more I, as a business broker representing a seller, have to explain to a potential buyer, the more difficult the transaction becomes, the more likely the transaction is going to go south. And quite honestly, which is a fair thing, the buyer may start to think, okay, oh my God, if this guy is doing all these things that are inappropriate to reduce taxes with the IRS, taking all these shortcuts, doing all these things that are not kosher. Is this the business that I want to buy? Because there may be skeletons hidden in the closet that I'm not capable of figuring out. But once I own the business, all these things are going to explode. Is that the type of risk I want to take? Not to mention the fact that a lot of times, there's some earnouts, there's some training and transition period, maybe there's some employment contracts, consulting agreements, whatever. So you as a buyer have to figure out if this is the type of person that you want to have an ongoing relationship, at least for a while after closing, and does that make you nervous or not?
Yeah. And I think the thing that people don't realize is once you buy the business, you inherit most of those problems. So you really, on both sides, need to think about what are we selling, what are we buying. And, I've had some significant transactions that at the very last minute fell apart because the seller, all of a sudden we saw some tax issues that came up that we thought were resolved. And while they still were going to go onto the seller, that threw a lot of doubt into my buyer's mind of what actually was being told, to them. So that,
because once you lose faith, once you lose trust, once you think that there's landmines and skeletons in the closet, it becomes very hard to do that transaction. The other thing that I'll give you as a quick example where these things can get very complicated. Let's say there's a spouse there that is working 10 hours a week as opposed to, let's say, the normal 40 hours a week. But they really do work there. They may run payroll. They may generate purchase orders or invoices or whatever the case may be. Now we're in a situation where it's not fair to add back in her entire salary because she is doing 10 hours worth of work. Now we start getting into this discussion of, okay, can somebody else do that 10 hours worth of work? Can the new owner do it? Can somebody else in the business do it? And then also, or do I need to find a part-time person or a payroll clerk or whatever to continue doing this, and then at what rate? So now you've put a lot of things in motion that need to be figured out, be estimated, and more importantly, be agreed to between buyer and seller, because that's part of going back to what determines the value of the business as these adjustments. And the more complicated the adjustments become, the harder it is for buyer and seller to agree on what the adjustment is and then what the value of the business is.
I'm going to put on the other side, I've had clients that have gone to purchase the business, and there has been a relative, a mother, in one case, a husband, a wife who has been in that business and is an essential part of it and actually works at least 40 hours a week, but does not get paid. And boy, does that, all of a sudden add another, oh, you have that cost. This person does payroll. This person opens up in the morning. This person does this, that. This person actually is the one that keeps everybody calm, the human relations person. So that is.
No, you know what? You're absolutely right. And that's why it's very important to do a due diligence, and to do a due diligence not only of the paperwork, but to go there, to observe, to talk to the people so that you can ferret out this type of thing. Because, by the way, some of this may also happen at home as opposed to on the business location. So you need to be able to figure out, to your point, and you're absolutely right, is somebody applying labor, is somebody providing value that is not getting paid for that, whether it's on site, at home, on the weekends, however it is. And then you as a new owner, how are you going to make sure that that continues to happen, and what's that going to cost you?
Yeah, yeah, and that's that break-even analysis may rapidly change. It's still may be worth doing a business, but all of a sudden, that person that was doing all that stuff, oh, I have to pay someone at least $40,000-$50,000 to do that, and that's how they were, making money, so to speak, is by not paying, and the husband would take the paycheck, but the wife really, and in one case, a man really was the one who was doing the stuff that made the administrative stuff that made all the difference in the business.
Yep. No, you're absolutely right. And unfortunately, when we're dealing with these smaller sort of Main Street type businesses, a salary or an expense or whatever you call it in the $40,000 to $80,000 range could have a significant impact on the valuation. I mean, that one item alone is the one that could cause a huge disconnect between buyer and seller.
Yeah, yeah. I wanted to ask you, because this is always up for debate, the term goodwill. People add that. That's worth, hundreds of thousands of dollars. And what do you think of that? Because I don't like the term goodwill that much.
Well, I neither like it nor dislike it. Maybe let me start by explaining, right? Goodwill is basically the difference between the purchase price that a buyer is willing to pay in an arm's length transaction. And, we go with full information and all the disclosures versus sort of the specific assets that you can identify. So as an example, maybe you identify, whatever, 500,000 in specific assets, but the seller or the buyer is willing to write a check for 600,000. So that gap of 100,000 is goodwill. Now, the way you can think about it is it can represent a collection of intangibles that are maybe a little bit harder to value and not so obvious. So for example, the fact that he's run the same business in the same location successfully for 30 years, that has a value. The fact that he has a brand, which may not be necessarily McDonald's, but maybe within his community, he's created a brand. The fact that independent of his brand, he also has a reputation within that community. Like, hey, go to Joe because he's a good plumber and, he'll fix your leak. So, all that collection of things to me get wrapped up in that sort of goodwill umbrella. I guess so it's a fair concept and it's a fair term. I think from the buyer's perspective, you just have to make sure that that's not going to go away or dissipate when you take over. Because by the nature of this thing being sort of intangible and amorphous and an accumulation of experiences in the community for 30 years, it's very easy to destroy goodwill. As it's more difficult to destroy machinery, which is a piece of metal or plastic or inventory or a building that's real estate. So, I'm not in favor of against. I don't think there's right or wrong to goodwill. Just be careful because again, it's one of the more fragile things you're buying.
Yeah, I've had. I once tried to sneak through with a banker who, man, Pete put me through my paces all the time. I put a certain value in the goodwill, and he called me in his office. Then I thought, oh, I know, I'm going to get lectured. And he looked at me, and it was a bridal shop, and they had been in business a significant period, and they had some prominent people and as their customers. But he sat there and he looked at me and he said, "Goodwill, I hate. I only have 3 daughters. You can only dress 3 daughters in gowns. I don't care if they get married, And he says, get this out of here." And man, he wiped 90% of the goodwill out. Fortunately, we had enough. But man, there are times when you get slammed by your bankers, and that was one time
Yeah.
that just.
Well, and again, the hard part is, goodwill by, is intangible. I mean, it's not like you can say, hey, let's go count inventory. Let's take a picture of this machine, right? Here's this real estate that's, brick and mortar. I mean, goodwill is again intangible, but, in fairness, it's not less valuable. I mean, look at intangible assets. How much could a patent be worth? How much could a brand be worth? A trademark, a logo, whatever the case may be. We are living in a time where sometimes, quite honestly, even for small businesses, the intangible assets could be worth more than the tangible assets, especially for service type businesses that tend not to have a lot of tangible assets.
Yeah, the intellectual property often has become a big issue these days, and pricing it accordingly. I wanted to ask you about. So we've talked about goodwill. I'm very stingy on it. You sound like you're more generous than me. When
Well,
you
remember, you represent the buyer, I represent the seller.
I know. One of the things that when we talk about goodwill, when we talk about intellectual property, that's where I was going. I had a client who did a merger, and they put a certain value on a data bank that they had. And they said, oh, we have a data bank of 2.5 million customers, and we've gotten X amount of sales out of that. And my client just thought that was like, gold. And I'm sitting there and I'm getting exceedingly cranky. It's like, and even though, and she went against my word. Because I felt, because I've run 9 advertising agencies in one of my lives, and I know the data bank is as only fresh as that day. It changes every 6 months. Your data bank may have a loss of at least 20% of good addresses, and we pay an excessive amount for that data bank, which ended up not having the goodwill that they talked about, it wasn't a clean list, a list that was up to date. And that was for her, a very expensive lesson. And even though I turned out to be right, I preferred to have been wrong, because she paid too much for that business, is what I'm saying. So I think people need to be very careful with the type of asset they consider an asset when they're buying something like a database. They're buying something, a software, things like that. That can be very dangerous.
Oh, absolutely. I mean, I had a case a while back where one of the assets that the seller identified was basically a list of email addresses. And I forget how many there were in this database, but I don't know, whatever, somewhere between 3,000, 10,000 email addresses. And again, this is an intangible. So it was interesting because, quite honestly, even though I was representing the seller, I thought he had overvalued this list of email addresses. One of the potential buyers basically wanted to say it was worth absolutely nothing, zero, because it was all, just intangible assets, email addresses, zeros and ones sitting in the computer. One of the things that I did to kind of try to bring them together is I said, okay, let's at least, because to me it's obvious they're not worth zero. And I said, okay, listen, let's at least start with figuring out if you're going to buy email addresses, because you can buy these. How much would it cost to buy whatever it was, 3,000, 10,000 email addresses? And there's different services online that you can go and just buy these. And also, as you become more specialized on the email addresses that you buy, the price goes up.
Right.
Okay. Now, still, we couldn't honestly quite get there 100% because these email addresses he had harvested through his website, through transactions that he had done. So these are people that had either bought from him in the past or at least had interacted with his website, which was very specialized product that he was selling. So these were very specialized email addresses, which in my mind deserved a premium over
Had a value.
an email address that you could buy from a vendor on a database, no matter how many filters and qualifiers you put on there. But to your point, who's right, who's wrong? What are these things exactly worth? You know, how fresh or stale they are. Because he bought in the past doesn't mean he's going to buy in the future. Because they went to the website doesn't mean they're going to buy in the future. This, I think, is a little bit of what makes my job interesting and sometimes challenging. Let's use that word.
Yeah. Well, as people can see, it gets very complicated when you try to make a deal. You're not only dealing with the facts, you're dealing with people's opinions of what's going on, and you're dealing with feelings, which often aren't logical. So, this has been an interesting conversation. Sal, what's the best way to get a hold of you?
Very easy. You can call me on my cell phone, area code 484-358-9470. You can email me at sal459 at yahoo.com. Here, I will show you my most valuable asset before we end this call. This guy right here is the most valuable asset that I have. But again, real quick, 484-358-9470 and Sal, SAL459 at yahoo.com.
Okay, and I am JoAnn Forrester, the Empress of Biz. You can reach me at Empress of Biz at gmail.com. That's Empress of Biz at gmail.com. My landline is 412-440-6969. That's 412-440-6969. And the cell is 412-670-4322. That's 412-670-4322. Sal, do you have any things you want to add as a conclusion of, as we're talking about the type of things that we need to do to get ready either to buy or sell?
No, the only thing that I will add is please don't procrastinate, because as we've said multiple times in these videos, these transactions take time to execute, and now more than ever, they're going to be more complicated than ever. So if people want to contact me, even if they're just thinking of selling at some point in the future because they think they're a couple of years off from retirement and maybe right now is not the best time to be trying to do a transaction, whatever the case may be, feel free to contact me. I don't mind. We can have a conversation, and hopefully I can give you some ideas and some tips that will make it easier for you to achieve your transaction whenever in the future you decide to do it. I don't mind having early conversations.
And I like to hear from people when they're thinking of doing things, because I find that just jumping in, a lot of times they sabotage themselves. They can't get the money. Whereas if they had done it correctly and we had been prepared, we could get the money. We have the strategy. We can get people on board. We can make a deal that people may hold money. There's all kinds of things that can be done. And I think the next time we talk about this, let's talk about what it takes to actually make a deal. Like, um, when you are, if you are the seller, you decide to hold paper. What does that mean? What does that transaction mean? Maybe we can get a banker on sometime to discuss this with us. But I think this has been a good series. And folks, if make sure you get in touch with us so that we can help you get the deal. Let's make a deal. Let's, we can get the deal that you want that benefits all. This is the Empress of Biz wishing everyone, stay well, stay protected, use common sense, and we look forward, and things are going to open up. The world's not going to go away. It's just going to be, there may be some better ways of doing business. I mean, I actually did a Zoom conference the other day, and I'm getting better at getting online. So this is good. Sal, thank you for your time.
Absolutely. Thank you. And best wishes to everybody. Stay indoors as much as possible. Stay healthy. And we're almost out of the tunnel.